Yes, I know exactly how it feels to have no money. I used to be a waiter and then I became a multimillionaire. I even have a video about it, which you can check out in the card I want on the screen. But early in my career, I had limiting beliefs like money brings problems, money is evil, investing is only for the rich, and I want to break down these thoughts by teaching you how to invest with little money. And by the end of this video, you know exactly how to build your stock portfolio with less than $500. And I'll break it in 4 parts. First, timing the market. Second, investing in ETFs. Third, picking stocks. And fourth, a portfolio sample. So stick with me and don't forget to like, subscribe, and leave a comment below. I'll answer all of you guys as I'm doing on the previous videos. Let's dive in. First, timing the market. One of the biggest misconceptions about investing is that you need to time the market perfectly to succeed. But the truth is, it's incredibly difficult, even for professionals, to predict when the market will rise or fall. There are 2 strategies: dollar cost averaging, the DCA, and buy the dip, which are often compared. With DCA, you invest a fixed amount every month, regardless of market conditions. For example, if you have $1,500, you would invest $125 each month for 12 months. This method ensures that you are consistently investing, smoothing out market volatility. And let's do some math. Month 1, ETF price is $50. So if $125, you buy 2.5 shares. Month 2, price drops to $40 and you buy 3.12 shares. Month 3, price rises to $60 and you buy 2.08 shares. Month 4, price is $55, so you buy 2.27 shares. And month 5, price rises again to $70 and you buy 1.78 shares. After 5 months, you've invested $625 and own 11.75 shares with an average cost of $53.19 per share. This steady investing, regardless of market fluctuations, lowers your risk of buying at the wrong time. The other strategy is buy the dip, where an investor only buys stocks when the market hits a low point between 2 historical highs. For example, let's say the stock market was at 100,000 points, then it dropped to 90,000 points before rising to 110,000. In this strategy, you would buy exactly at that 90,000 point low instead of investing consistently each month as you would with DCA. But if the market doesn't dip, you simply don't buy anything. Now, to pull this off, you need a crystal ball to perfectly predict every time the market's going to drop so you can make your moves. So, if you had a crystal ball and could foresee the perfect times to invest, obviously that would be the best way to go, right? Actually, no. The study's results are right there on the screen. This chart shows the performance of these 2 strategies over the last 40 years, with $100 invested each month in the S&P 500. The black line represents DCA, where you buy every month, and the blue line represents buy the dip, where you only buy at the low point between 2 highs. What's the takeaway here? The takeaway is that waiting for the perfect moment to buy stocks isn't worth it. Many people in the market are constantly waiting for the perfect time to invest. But actually, the truth is that moment doesn't really exist. This study shows that time, combined with the power of compound interest, is far more important than trying to time the market. Even if you were a genius and could predict every market bottom, you would probably still lose out to someone who simply invested regularly each month. So invest every month. Don't try to predict the future and don't try to time the market. Regular investing will give you much better returns in the long run than trying to outsmart the market, which, let's face it, is nearly impossible. Second, investing in ETFs. So you've got $500 or less and you want to start investing, right? One of the smartest moves, especially if you're new to the game, is to look into ETFs. These are like a basket of stocks or bonds. Basically, you're not putting all your eggs in one basket, which is key when you're starting small. Think of it like this. Imagine you are at a buffet and instead of filling your plate with just one type of food, which could end up being a terrible choice, you grab a little bit of everything. If one dish isn't great, you've still got other good options to keep you satisfied. That's what ETFs do for your money. They spread your risk across multiple companies. Let's say you invest in the SPDR ETF. This ETF gives you a piece of many companies in the US stock market, meaning you're not betting everything on just one company. If one or two companies have a bad year, no worries. You've got many others working for you. Here's how it might look in practice. Let's say SPDR is priced at $67.40 per share. You take your $500 and buy around 7 shares for a total of $471.8. You've still got about $28.2 left over, which you can either save or use for your next investment. That $67.4 isn't tied to just one stock. It's spread out across multiple companies like Apple, Google, and Coca-Cola. And let's look at some history. The S&P 500 has averaged an annual return of around 10% over the long term, even when factoring in market crashes and downturns. For example, from 2010 to 2020, the S&P 500 grew over 190%. Even during tough times like the 2008 financial crisis, the market rebounded and continued its upward trajectory. This kind of historical return shows why investing in a broad index like the S&P 500 or ETFs can be a smart move. The beauty of ETFs is they make it easy to diversify, even with just $500. You are lowering your risk because your success isn't tied to the fate of only a single company, something crucial when you're just starting out. Plus, it's hands-off investing. You don't have to stress about picking the right stocks because you're already getting a slice of a whole market. So whether you are in it for the S&P 500 or the whole stock market, ETFs are like your set it and forget it approach to building wealth over time. Third, picking stocks. Once you've set a strong base with ETFs, it might be tempting to explore individual stocks to boost your returns. And while ETFs give you the broad safety net of diversification, picking individual stocks can be more like putting chips on a few key players. It's riskier, but with the right choices, the rewards can be much higher. Let's say you decide to allocate $200 of your $500 to 2 specific companies you believe in. The math here is simple. You invest $100 in company A, priced at $25 per share, and you'd buy 4 shares. $100 divided by $25 equal 4 shares. You invest $100 in company B, priced at $50 per share, so you would buy 2 shares because it's $100 divided by 50 equals 2 shares. Now you are invested in 2 companies. But which ones should you pick? To make solid choices, you need to focus on fundamentals. The first fundamental is price to earnings or PE ratio. The PE ratio is one of the most common metrics investors use to assess whether a stock is over or undervalued. It compares a company's stock price to its earnings per share, the EPS, and in general, it follows something like that. A high PE ratio might indicate the stock is overvalued or that investors are expecting high future growth, and a low PE ratio could mean the stock is undervalued, but it might also signal slower growth prospects. For example, if company A has a PE ratio of 20, that means investors are willing to pay $20 for every $1 of earnings the company generates. Don't forget to compare this to the industry average or competitors to determine whether it's priced reasonably. Don't forget about that. And the second fundamental is the dividend yield indicator. If you're after passive income or stability, dividend-paying stocks are a good choice. The dividend yield is calculated as the annual dividend payment divided by the stock's price. I made a video specifically about passive income on this channel, and I'll include it as a card on the screen right here. But for example, if company B has a stock price of $50 and pays an annual dividend of $2, the yield would be 4% because you have the $2 divided by $50 and it equals 0.04 or 4%. High yield dividend stocks can be attractive for steady income, but watch out for unusually high yields, which can sometimes signal that the stock price has fallen due to problems in the business. The third is market capitalization. We call it market cap. The market cap shows the total value of a company's shares. Smaller companies, the small cap stocks, may offer higher growth potential, but they're often more volatile. Larger companies, we call it large cap stocks like Apple or Microsoft, tend to be more stable but might offer slower growth. For example, company A might be a small cap stock with a market cap of $1 billion, meaning it has room for aggressive growth. Company B could be a large cap stock with a market cap of $100 billion, offering stability but less explosive growth potential. The fourth fundamental is growth versus value stocks. Growth stocks are companies expected to grow earnings at a faster rate than the market average, like Tesla or Amazon. They often reinvest profits back into the business rather than paying high dividends. If you believe in the long-term vision of a company, growth stocks could pay off big. Value stocks are more stable companies trading at a lower price relative to their fundamentals. Think of companies like Coca-Cola or Procter & Gamble. They're typically less volatile and often pay dividends, making them a good choice for conservative investors. Now let's look at the real numbers. Say you want to split your $200 between a growth stock and a dividend-paying stock. You invest $100 into, let's say, Apple, currently priced at $225.7 per share, and you can buy about 0.44 shares. Apple is a large cap. It's a stable company with a solid track record of growth and innovation. And you can also invest $100 into AT&T, priced at $21.86 per share, known for its high dividend yield of around 7.8%. You can buy about 4.58 shares, and even if the stock price doesn't grow as fast as Apple's, you receive income from dividends. While Apple could deliver capital growth, AT&T could provide regular cash flow through dividends. Over time, reinvesting those dividends and holding on to Apple as it grows could lead to significant wealth building. And here's a curiosity. You can buy 0.44 shares of Apple because many brokerage platforms now offer fractional shares, which allow investors to purchase less than a full share of a company's stock. This is especially helpful when investing in expensive stocks like Apple, which is priced at $225.77 per share. Now let's take a look at a portfolio sample. Let's put everything we've talked about into practice with a portfolio you can build with $500. Since I'm assuming you might be inexperienced or just starting out, it makes sense to invest 60% in ETFs for diversification and stability, and the remaining 40% in individual stocks for a mix of passive income and growth potential. And a big disclaimer right here, this information is for educational purposes only, not financial advice. Examples are always based on historical data and may not reflect your personal situation, including taxes or fees. Past performance doesn't guarantee future results, and I'm just giving an example to show how it works. I want you to understand so you can apply it however you prefer using all the fundamentals I mentioned earlier. So here's how you can split your $500. First, ETFs. You can put 60% of everything you have on ETFs. Let's say you invest $300 into the Vanguard Total World Stock, the ETF VT. Why? This ETF gives you exposure to the global stock market, ensuring diversification across different regions and industries. It spreads the risk, which is crucial when starting out. The current price per share is around $118.96. That means you would be able to buy 2.52 shares. Historically, this ETF has returned around 8% annually. So my $300 investment could grow to approximately $324 after 1 year. The second may be dividend stock. Next, I would allocate 20% to a reliable dividend-paying stock to generate passive income and provide some stability. For this, you can use a company like Verizon, the VZ. Why? Because Verizon offers a strong dividend yield of about 7.6%, making it a good choice for generating regular income. If you invest, let's say $100, the price per share is around $44.05, so you would be able to buy 2.27 shares. With a 7.6% dividend yield, I'll receive approximately $7.60 in dividends over the year. And additionally, with an expected price appreciation of around 2%, my $100 investment would grow to $102 after 1 year. And the third part of my portfolio could be growth stock. Finally, I would put 20% of it into a high growth stock like, let's say, Nvidia, which comes with more risk but also offers higher reward potential. Why? Nvidia is a tech leader in GPUs and AI and has shown strong growth over the years. If you invest $100, the current price per share is around $133.38, which means you would be able to buy around 0.75 shares. Nvidia has grown around 38% annually, so my $100 investment could grow to approximately $130 in 1 year. After 1 year, here's the total portfolio value. It's $572.40. Of course, investing $500 once is just the beginning. The real key is to invest $500 every month to truly build long-term wealth. Consistency allows your money to grow and compound over time, leading to much higher and bigger results in the future. Make it a habit, stay committed, and watch your investments grow. And if you enjoyed this video, please like, subscribe, and hit the notification bell for more content. Thanks for watching and see you next video.